Carmignac. Tenemos con nosotros a Kevin Thozet, es el miembro del comité de inversión de la gestora. Kevin, thank you so much for having us a few minutes.
Hola.
Kevin, we saw yesterday how the ECB raised its interest key rates by 75 basic points and promised further hikes. One of our questions right now is, well, what did you expect from this meeting? It was according to what you expect, and in which way will this rate hike affect the rest of Europe and markets?
Sure. Well, yes. Well, she did indeed rise rates by 75 basis points. It's the first for the European Central Bank ever, and she did send a very hawkish message indeed. The target is for the ECB to be very rapidly into restrictive territory, and we do not expect a change in path going forward. So she will likely continue on this very aggressive hiking path going forward, because she did send a message that the bar was very high for her to, I'd say, pivot or change course of action. Indeed, when we're looking at growth and inflation forecast from the European Central Bank staff, they expect inflation to remain at very high level and much higher than its mandate all through 2023 and 2024. As per was this surprise for financial markets? Well, markets clearly are approving this decision, and they expect, or they see the ECB as being very credible, that they will not abandon the euro, they will not abandon its inflation mandate. And we are seeing this today. The euro is significantly up. European equity markets are faring very well as well, potentially also helped by prospects of good news on the energy crisis. With regards to the second part of your questions on the impact on, well, first economies and then interest rate markets, well, for now, this tightening path is not triggering a risk of fragmentation within the European bond markets. So we have to ensure and to continue to pay very close attention to make sure that those spreads of the most fragile country in Europe continue to behave well. The consequence on the economy is that the pace of tightening is going to be quite aggressive, I would say, and that's negative for investments, and it's negative for real estate markets as well, and notably for those countries where there's a significant, I would say, portion of the loan market, of the mortgage market, which is adjustable rate. So that's one consequence. The impact on interest rates markets, well, we believe that it's important to remain very cautious on the direction of bond yields. They're likely to continue to move higher, even more so because, as we have seen in the UK over the past couple of days, probability is that we will get very significant stimulus in the face of the energy crisis over the coming weeks and months, that all this stimulus will be financed through debt, and this means more debt issuances, and we will see a natural historical buyer of those sovereign bonds, which will be moving out. So some message of, I'd say, cautiousness on the interest rate side on that front.
So, for summarize, Kevin, do you consider that Lagarde's message was convincing for markets?
Yes, clearly, when we're looking at the price action today, so the trajectory of the euro, which is appreciating, and we can come back on this if you will, when we're looking at the direction of equity markets as well, it's clearly she managed to convey, I would say, a message of credibility for now on its inflation mandate, and the fact that she will stick to its inflation mandate, and on the fact that she's looking very closely at what's happening on the euro side as well.
And from Carmignac, what do you expect from the euro dollar from now on?
Well, yeah, The US dollar has enjoyed a very great run over the past months, and the US dollar has benefited from, I'd say, various tailwinds. One is the growth differential, with the US economy, I'd say, benefiting from this resiliency in consumption. The second one is rates differential. The Fed has started to lift off its monetary policy since spring of this year. And the third one is commodities. I mean, clearly, us European are importing all our energy commodities now, are all denominated in US dollar. And on top of this, I mean, the euro suffered from, I'd say, a risk premium linked to the war. So a very, I'd say, one-way market on the US dollar, and conversely, one-way market to the downside on the euro. What can we expect, I'd say, going forward? Well, this path should be, I'd say, likewise downward oriented on the euro, and I can come back on this, but it will likely be more uneven. It will be less of a regular path going forward. Why? Because the ECB has posted, I'd say, a very strong response, and hence the interest rates differential between euro short-term rates and US short-term rates is narrowing, which is a factor of support to the euro. The second one is that the euro has been trending lower over years of gas cuts, and now this is done. So this is behind us. So now markets are likely to be looking at, what's the story on other aspects, and notably on the growth side. And on that front, Europe will be entering more into resilience mode, I would say, again with governments accelerating on the fiscal front. So the growth differential will be less negative. So that's probably going to bring a bit of relief on the euro side, as we are seeing today. If we're looking at more, I'd say, more long-term picture, well, in fact, this very hard stance of Madame Lagarde is being, similar stance is being adopted by Mr. Powell, and in fact, the Fed has hinted towards themselves conducting another 70 basis points hikes for the coming meeting. In the US, contrary to the euro area, there's not this risk of this dislocation. So, I mean, again, for now, fixed income markets are very well behaved, but the risk is that with this aggressive tightening, we could see more volatility on the spread front, and here coming, let's say, concerns over potential dislocation within the euro area. That's a problem that the US does not have. And what does this mean? It means that should they pivot one day, the US is likely to pivot after the European Central Bank. And finally, on the growth side, clearly over the short term, we should have some welcome, I would say, announcements on the fiscal side in the euro area, and maybe close to what has been announced in Spain, similar type of mechanism. But in fact, again, US growth seems much more resilient, and notably on the consumption side, where US wages should be trending in a, might say, much more favorable way over the coming quarter. So a bit of relief short term, but likely to continue on its downward trajectory over the midterm for the euro.
And one last question, Kevin. Considering the current market scenario, which investment opportunities do you see from Carmignac?
Yeah, so I mean, at Carmignac, or I'd say global house view, is that our portfolios should be built to face a global, I'd say, stagflation scenario, so that of decelerating growth and quite, I would say, sticky inflation on the downside. So what we do is that we put I'd say, very strong emphasis on risk management. So we are running portfolios with relatively subdued and low level of net equity exposure, low level and even some negative position on the interest rates front, some hedges on credit markets, but it's not all doom and gloom, and we also have some performance engines into our portfolies. One theme that we like, I mentioned the fact that the US consumer should be quite resilient, and that the US is some form of exception or within this slower growth, persistent inflation environment. And as such, we like some names within the consumer sector in the US, because consumption should continue to, I'd say, shouldn't be downward oriented as in the euro area. So we like typically names which are not suffering from competition from e-commerce, for instance, or not suffering from brands of distributors. So that's one team that we like, along with this team of resilience, I'd say, U.S. economy. So we are also long on the US dollar. Another team that we have in the portfolio is those rising concerns over the European economy, and markets have been, I'd say, very quick at pricing the worst for the European economy. A corollary to this has been that yields, and notably yields of corporates, have picked up quite significantly in the wake of higher interest rates, over concerns of higher default rates with the recession coming forward. But today on credit markets, we are, I'd say, increasingly remunerated for the volatility or for the volatile times ahead. So that's another team that we like to have in our portfolios, and notably within our fixed income portfolios, is that we are start to reconstitute exposure to those credit markets, where we get very decent level of yields between 5 and 8%. And one has to remember that, again, beyond, I would say, short-term volatility, over the long term, the performance of those credit markets is largely driven by yields and by the carry we're getting on those bonds, and clearly the carry has reconstituted nowadays.
Kevin Thozet from Carmignac, thank you so much for having us a few minutes.